Welcome to you all to this Inside India edition of for Thursday. I'm Sri Jegarajah. Here are your headlines. President Trump continues to tease a potential trade deal with India, saying they're close to an agreement. India may be looking to raise its energy imports from the United States to help those trade talks along, with state-run Gas Authority of India said to be in talks to buy LNG from the Alaska LNG project. And weakness in the US weighing on Tech Mahindra's quarterly results, the Indian IT services giant posting a revenue miss, as sales at its US division saw its heftiest drop in nearly 5 years. Once again, we're seeing a fair bit of dispersion in the Asian markets, and that really speaks to perhaps some confusion in the global markets as they try to price this quite antagonistic relationship between President Trump and Fed Chair Powell. Markets recovered in the US after a brief sell-off on reports and some confusion about Powell firing. The Nasdaq posted its fifth record high in the last 6 sessions, and bank stocks were mixed after Q2 earnings. So translation mixed over here as well in the Asian markets. Indian markets join us in about 45 minutes' time. Here's what GIFT Nifty futures are indicating for the open. 25,276. We left off at 25,212, and the benchmarks yesterday in India settled largely flat as gains in some of the state-owned lenders were offset by losses in the metals market. Let's give you the exchange rate as well, and dollar rupee at 85.95. US-India mini trade deal is back in focus. Indian negotiators are set to wrap up talks in Washington today. So far, no deal has been reached, despite several rounds of discussions. Still, President Trump continues to insist an agreement is coming soon.
We had one yesterday, that was announced. We have another one coming up, maybe with India. I don't know. We're in negotiation. When I send out a letter, that's a deal.
Meanwhile, as the US considers 100% secondary sanctions on Russia, India's oil purchases from Moscow are still rising. Imports from Russia jumped 17% in June compared to May. However, on a quarterly basis, they declined slightly by just over 1%, while its crude imports from the United States rose over 22%. And to further increase the country's energy purchases from the US, Indian state-run Gas Authority of India Limited is reportedly in talks with Alaska LNG for a long-term deal. However, these discussions are still preliminary and dependent on the landed price of LNG. GAIL plans to expand its import capacity as India aims to raise its gas use to 15% of its energy mix by 2030. It's not just President Trump's tariffs that countries are grappling with. Immigration is also a big focus of his policy, and many Indian nationals are feeling the impact of tougher US visa rules. Experts warn of longer wait times, more denials, and new reasons for rejection. And it all puts the spotlight on India's ongoing brain drain as skilled talent heads abroad for better jobs and lifestyles. And it's not just professionals. India's wealthy are also leaving. Henley & Partners report ranks India third globally for millionaire migration. The report estimates over $26 billion in wealth flowing out of the country as these millionaires leave and take their wealth with them. Let's talk about this in a bit more detail with Sanjay Baru, former spokesperson for Prime Minister Manmohan Singh. He is an India policy analyst and political commentator. He was also an editor at the Financial Express newspaper. Sir, thank you very much indeed for joining me and giving us your thoughts on this issue. First of all, sir, why are India's wealthiest citizens and increasingly the Indian middle class moving abroad?
Well, first, let me thank you for calling me here. I have a Singapore connection. I used to teach at the Lee Kuan Yew School of Public Policy many years ago. And we are talking about my new book. It's called Secession of the Successful. It's just been published by Penguin Random House. And I focus both on what is called brain drain, which is a migration of talent, which has been long happening, almost 40, 50 years of brain drain that we've seen with many, many Indians going overseas, particularly to the United States and to Europe, but also to Singapore and other Asian economies. But more recently, what we see is what I call the wealth drain. You've referred to the Henley report about Indian millionaires, 23,000 millionaires in the last 10 years. And the latest numbers you mentioned there are 3,500. Well, why do, wealthy migrate? I mean, wealthy are migrating from many, many countries. They migrate for two reasons. One, because they can afford to, because more and more countries are selling citizenship. So you can actually buy a citizenship of many countries today around the world, and people are doing that. The second reason is that some countries attract people away with lower rates of taxation. Now, India, being a developing economy, continues to have fairly high rates of taxation by comparison to the Gulf, etc.
I wanted to explore that in some depth, Sanjay. And to what extent is this brain drain and now wealth drain reflecting dissatisfaction over job creation, some of these structural challenges, taxation structure, healthcare, education, and generally quality of life issues?
Well, quality of life is an issue, has always been an issue. And, when you have opportunities, then you take these opportunities. I think there are basically two reasons why we have seen this brain drain and will probably continue to see the brain drain. One is the fact that we actually produce fairly talented people. Our educational system still is able to generate a lot of professionals, doctors, engineers, scientists across different professions. And but our employment situation is not adequate to absorb this talent, or even the working environment sometimes is not conducive to making use of this talent. So, and then this talent is, sought elsewhere. We have seen, for example, in the United States, a deliberate policy of attracting Indians going all the way back to the 1970s. So the supply is available, there is demand, and basic law of economics, supply meets demand.
Just, you touched on the United States, Sanjay. Is the US increasingly being perceived as perhaps an undesirable destination amongst Indians looking to shift overseas, given the Trump administration's stance on immigration and visas?
Well, there are three categories of Indians going to the United States. One are the students. The second are what we call H-1B, talent, skilled workers. And the third are middle-class professionals. I don't think the demand for middle-class professionals is going down. And even President Trump has said many times that he would like to continue to attract skilled Indians into the United States. So I don't think at the top end there is any reduction in demand or reduction in flow. But certainly I think students are getting wary. The number of students applying for admission to the United States has gone down. They're looking at opportunities in Australia, New Zealand, other countries. And H-1B visas, I think there's a decline in the number, but still there are quite a large number of people being sought by American companies as skilled workers.
Sanjay, we were all familiar with that expression, the grass is always greener on the other side, but there's no denying, is there, the economic transformation that's taken place in the last decade in India under Prime Minister Modi. Only this week we've seen inflation continue to come down. A name like Tesla enters India. The economy is one of the fastest growing in the world. Isn't that, or shouldn't that, instill confidence among India's wealthiest, brightest and the middle class that the prospects are just as good, if not better, domestically?
Yes, in fact, for that reason, there is a decline in the out-migration. The numbers are not rising. Even the millionaires leaving the country, the numbers are actually declining. But still a large number go. And I think one of the factors that's actually contributing to this flight of out-migration or emigration of billionaires is the fact that Dubai, which is just next door, is attracting a large number of Indians. I mean, Dubai is just 3 hours away from Mumbai. And so a lot of Indians are now have become residents of Dubai. They fly back and forth. They have businesses in India. It's not as if they're shutting down their businesses in India. They continue to operate the business in India, but they become residents of Dubai. And Dubai, in fact, is also attracting many away from Singapore, because Singapore is 5.5 hours away from Mumbai, but Dubai is only 3 hours away. So you do see people leaving, but business is continuing to thrive. And I know individual businessmen who continue to operate their businesses in India, but live out of London. I mean, that's made possible by online, conduct of meetings and management.
So we need to distinguish between people leaving, millionaires, and the wealthiest Indian citizens leaving, and capital flight. So perhaps that number of $26.2 billion is somewhat misleading, because there are secondary businesses and investments that remain in India, yes?
That's right. I think what we see globally today is, you take the example in your data which you put out, a lot of people leaving England. Now, England is a developed economy, but why are they leaving? It's because of high tax rates. That doesn't mean that their businesses are leaving Britain. I think most of them relocate to the Gulf. Gulf has become an attractive destination for people who are seeking lower rates of taxation.
Lower rates of taxation. So if this movement, it's not necessarily a thumbs down to Team India and Modi's economic miracle, but it's a thumbs down to perhaps the system, the taxation system, and that is clearly in need of reform. We've seen initiatives, though, and the government hasn't been sitting still. Initiatives like gift cities, special economic zones, to encourage investment, both from domestic and foreign audiences. Is the government on the right track, and what more needs to be done, Sanjay?
Well, much more needs to be done. I mean, the Prime Minister himself, in his last, annual India's Independence Day address to the nation, talked about launching a mission for the ease of living in India. I think this is something which we desperately require. Just the day-to-day ease of living, whether it's dealing with your local bank branch, whether it's dealing with local utilities. I think the ease of living is something that a lot of people, particularly those who have lived overseas and come back, they seek better environment for just day-to-day living. And the Prime Minister has promised this, but he has not yet delivered on this promise. And I'm hoping that he will grapple with this challenge.
Yes.
Sorry. The second challenge is, in fact, the Finance Minister, Nirmala Sitharaman, in her budget speech last year, spoke about a commission for deregulation and ending what we call the regulation Raj, which is excessive bureaucratic oversight over business. We have many regulatory institutions which have become excessively bureaucratic. And I think there is recognition of the problem, but we need action in dealing with the problem. And finally, of course, there is this challenge of what everybody calls the ease of business. The number of forms you have to fill, the requirements for setting up business, the requirements for exporting, for importing. All these, the bureaucracy in India remains a challenge.
Yes.
Not just for businessmen, even for research institutions, for universities. There is increasing bureaucratization of university administration. So, there is a recognition that this is a problem, and I'm hoping, we will address this challenge as we go forward.
There are a lot of factors, there are a lot of challenges to unpack that the government needs to address. So, Sanjay, the Henley report called the migration decision an investment in the future, referring to education as a big factor driving the middle class and those with the financial means to leave India. Once again, is this, or how much is this, a wake-up call to Indian policymakers to undertake root and branch reform of the education system, especially at the higher levels?
Oh, this is a big wake-up call. I mean, I think this is a very important challenge, and I have recorded this in my book. The increasing number of bright Indian kids immediately after school leaving India and going overseas, including to Singapore. And I call this, we used to in the past go overseas to study and return home. Today we study at home to go overseas. And I have an entire chapter in my book looking at the number of Indian schools that are coming up that are actually training Indians to be able to get admission overseas. And I think this is really a challenge for the Indian educational system. One solution that we have tried to find for this is to encourage private institutions. A lot of private universities have been coming up. But I think the real solution has to be to improve the efficiency and the independence, the intellectual freedom and independence and administration of our public universities. Our public universities have been increasingly bureaucratized and politicized. And unless we improve public education, I don't think we'll be able to address this challenge.
Sanjay, there is also a deeper structural issue that explains the brain drain, and I'm sure your book addresses this, and these relate to issues surrounding job creation, particularly for recent graduates and new job seekers that are really struggling to find high-quality, high-paying jobs. How do you feel policymakers are addressing this structural challenge?
Well, this is a very difficult challenge to address because once you've created the talent and there is a global market for the talent will go wherever better opportunities exist and higher salaries exist. But India is still a developing economy, though it's now the fourth largest economy in the world and, we are playing a larger and larger role globally. But we still remain a developing economy. Our per capita income is a little over $2,000. And so, therefore, the ability of the economy to actually, generate higher salaries in various institutions, particularly public institutions, is limited. So how do we address this? I mean, in the past, we addressed this, like many Asian economies, by appealing to the patriotism of these talented people. I mean, India built its entire nuclear program under American sanctions, under Japanese sanctions, We built an independent nuclear program because scientists were willing to work, at modest levels of income. We built a space program. We are a major space power today, putting out satellites into the space and missiles. But that also we built with the public institutions that were not offering great salaries. So you ask the question, why did these people stay back at home while they could have gone away to the United States or other parts of the world? Because there was a sense of national commitment. And I think this has weakened despite the fact that we have a very nationalistic kind of political party in power and a very nationalistic prime minister. I think that sense of commitment to the nation has weakened with globalization and with global opportunities. And that's a political challenge. That's more of a political than an economic challenge.
Interesting perspective, Sanjay. So does that imply then that, and let's bring it to the here and now, that India needs to see more FDI, more trade deals? US-India trade deal is waiting in the wings potentially. Agriculture is a big stumbling block and a roadblock. If the more of these deals that we see, the more FDI comes in, is that going to be the catalyst to really lift confidence levels amongst new aspiring job seekers and keep people back at home?
Well, I'm not an optimist when it comes to President Donald Trump and today's America. I don't see them solving our problem. In fact, they have become a problem for the entire world. President Trump is today challenging developing countries in Asia, across Asia. And I don't think we in Asia can look at the West as a solution to our problem. We need to look inwards. We need to look within our neighborhoods to look for new markets and new opportunities. And I hope that, at home, we are able to encourage greater investment, because in the last few years, we have actually seen more Indian investment going overseas than FDI coming into India. Indian companies are actually investing around the world. I think we need to retain them at home. We need to create the demand at home that keeps this investment. But certainly, I think, we in Asia have to look at Asia for the rise of Asia. I think today the United States is in a desperate gamble to retain its global supremacy, which I'm
Yes.
not convinced is going to help many of us in Asia.
Sanjay, a final question. Do you ever see or foresee the conditions arising that would be conducive to help to create a reverse brain drain, to see or to generate the interest amongst Indian origin US tech leaders, for example, like Satya Nadella and Sundar Pichai, to return at some point to India, to the motherland, and start businesses there and invest more in India?
Well, there is some return migration. I mean, we see now, particularly in the IT sector, with a lot of global capability centers coming up in Hyderabad and Bengaluru, there is a return migration. It's still a trickle. I hope it's the beginning of a process. But I don't see families that are settled overseas with children, grandchildren already, American citizens or British citizens relocating back home. But I do think that those who are now going or have gone in the recent past may find it more attractive to come back because opportunities in the West are no longer as secure or reassuring. And Western societies, particularly American society, is becoming increasingly challenging. Which is why I think there is an opportunity for us in Asia, and I hope we make use of this opportunity.
Sanjay, it's a fascinating conversation. Thank you very much indeed for joining me, sir, with your perspectives. Sanjay Abaru there.
Thank you.
Thank you, sir. Quick check on the price of gold, and this is what the precious metal is doing in Asian trade. 3,340 or thereabouts is where we're trading. Higher prices are denting demand in India. Gold imports dropped 40% in June, hitting a two-year low. India, the world's second largest gold consumer, relies heavily on retail buyers, but many are staying away as prices continue to climb. Analysts expect gold prices to remain elevated amid global uncertainties, likely keeping the demand muted in the months ahead. Coming up, many reports surfacing around the Air India crash investigation. Will bring you the latest after this break. Welcome back. The probe into last month's fatal Air India crash is now zeroing in on cockpit conversations just before the impact. The Wall Street Journal reports that US officials believe one pilot may have cut fuel to the engines. The report says the flight's first officer asked the captain why he cut off the fuel, with the captain replying that he did not. The preliminary report published by the AAIB had not clarified which pilot initiated the conversation. Separately, India's investigators are also examining possible electrical or software faults that could have triggered the fuel cutoff without command. Staying with the aviation sector, Britain has lifted a 5-year ban on Pakistani airlines, clearing the way for Pakistan International Airlines to resume flights to the UK. The ban was imposed in 2020 after a deadly crash exposed issues with pilot licenses. The move follows safety improvements by Pakistani authorities and similar steps by the EU earlier this year. PIA says it's finalising plans to restart flights, beginning with the Islamabad-Manchester route. This comes as Pakistan pushes to privatise PIA, hoping revived UK routes will boost the airline's value ahead of final bids later this year. Etihad Airways is raising its growth target, now aiming to fly 38 million passengers a year by the year 2030. That's up from 33 million. The Abu Dhabi-based carrier plans to expand 15% annually, adding 20 planes each year and new routes worldwide. Airline just ordered 28 Boeing jets to support this push. In an interview with domestic media, CEO said demand is strong and safety, service and profitability are all improving. Etihad hit a record 20 million passengers this year and plans to fly to more destinations. Coming up on the programme, we'll take a look at India's insurance sector. Companies are reporting strong earnings, but are citizens benefiting? That discussion coming up after we take a short break. Stay with us. Welcome back. President Trump and his unhappiness with Fed Chair Jerome Powell is back in focus today. Reports emerged that President Trump was once again considering firing Jay Powell, sending the S&P 500 and the Nasdaq down 1% at one point. But markets did stage a recovery once President Trump denied the rumor.
So, no, we're not planning on doing anything. We're very concerned. He's doing a little renovation for $2.5 billion of the Fed. Building a renovation, and they have a close to $900 million cost overrun, and it's a shame. But the biggest cost overrun is the cost overrun for interest rates, because we should be paying 3 points lower, and we would save $1 trillion a year in interest if that were the case. And all it is the stroke of a pen, and that goes for his board too, because his board is not doing the job.
Dollar index had a similarly rocky session, initially dropping below the 98 handle again, but now back at 98.52, the DXY. Benchmark 10-year Treasury yields initially jumped, then paired gains. Investors sold off the long end of the Treasury curve, pushing it to a near 8-week high. And we are counting down to the market open in India. This is how we are shaping up. Gift Nifty futures are indicating an opening number in the region of 25,278. So that suggests some very mild upside. Let's call it little change from where we left off yesterday at 25,212. Earnings season, of course, is going to be the big driver for sentiment and confidence for the Nifty 50 dollar-rupee exchange rate. And, of course, the trade deal is still front and centre in the minds of many in the market. 85.9. We've been pivoting around this 86 handle for quite some time now, actually. The Indian market regulator, SEBI, has given Jio BlackRock approval to launch 5 passive funds in the country. The funds will mirror 5 indexes, including the Nifty 50 and the benchmark index tracking Indian government bonds with 8 to 13-year maturities. The JV between Reliance's Jio and BlackRock aims to disrupt the Indian market using its digital network to bypass traditional distribution channels. And it plans to add nearly a dozen equity and debt funds by the end of this year. And we're taking a closer look at India's insurance sector today with big earnings updates from the top players. First up, HDFC Life posted a 14% jump in first quarter profits, driven by lower claims and strong demand for group policies. Similar story at ICICI Prudential Group. Policy premiums helped push revenue up 34% in Q1. And its sister firm, ICICI Lombard, also reported profits up nearly 29%. Thanks to strong performance in retail health and auto insurance segments, demand for health insurance in India continues to surge as rising medical costs and COVID-era awareness drives more people to buy coverage. But despite the surging profits, new business premiums in life insurance did drop over 3% last month, marking a reversal from 12% growth in May. Let's get more on the outlook for the insurance providers and bring in Samant Singh, insurance research analyst at Phillip Capital India. Samant, welcome to the programme and thank you. You say that India's
Good morning.
Insurance sector is an attractive medium-term proposition. Good morning to you. So who then among the listed names are best positioned to capture the growth and market share?
Yeah, good morning. Thanks for having me. In terms of, we turned positive on the sector recently because if you see the background in the last couple of years, there was regulatory overhang on the sector, be it because of some union budget and the regulatory interventions. So because of that, the sector has seen some de-rating, despite the fundamentals of the sector in terms of embedded value growth or the return on embedded value being very strong. So we are talking about close to 20% of return on embedded value and embedded value CAGR over the last 5 to 6 years. Despite that, the de-rating had happened. So we are more sort of hopeful of seeing a more benign regulatory environment going ahead. And because of that, we turn more constructive on the sector. Within the space, we like the companies which have more distributed set of product mix as well as the distribution channel. So as you already alluded, the NBP, the new business premium, has seen some degrowth due to pressure from the regulatory changes that were implemented in last year, beginning October. So what we are seeing that the companies like HDFC Life and Axis Max Life, which have very well sort of diversified product mix, be in
Yes.
terms of ULIP, yeah, in terms of the traditional savings products, they are doing very well. And as such, if you see the quarter one results, in terms of the AP numbers, HDFC Life reported around 12.5% of growth, because that is more relevant metrics rather than the NBP for the life insurance sector. And
Yes.
yeah.
Okay, so sorry, if I may, so you prefer general over life insurance. Just help us understand in a bit more depth, perhaps, why ICICI Lombard General and Max Financial Services are your top picks. And while we're at it, how would you characterise valuations amongst the listed names that you cover?
Yeah. So coming on to the life insurance and general insurance sector, I am slightly more constructive on general insurance sector because of it has a secular growth story, be it from the commercial lines of business, so engineering, liability, fire, all those lines of business. I see strong growth opportunity in that. Swiss Re also sort of for the next 5 years, the growth projection, other than the inflation adjustment, it sees around 2 to 3% higher growth for the P&C sector, general insurance sector. So the growth itself is not an issue for general insurance sector, but for life insurance sector, what we have seen that the growth in the previous years was primarily led by ULIP growth, and that was driven by the buoyant markets. But we see that as and when the capital markets remain turbulent, the ULIP-driven growth will be slowing down, and that is already playing out. But that is slightly offset by demand in traditional products. Coming back to the companies we prefer, general insurance, Lombard is our preference because it commands the highest market share in the motor market. It is slightly, in terms of the valuation, slightly stretched, but there is still a scarcity premium because it is the only company which is properly multi-line P&C company in the Indian space.
Yes.
It trades at around, so we value it around 5.6 times book to
Yes.
price to book for 27. For Axis Max Life, we think that it is a bit of underappreciated story, whether its fundamentals are quite closer to HDFC Life. So if you see the valuation gap between HDFC Life and Axis Max Life, there's a still pretty healthy discount. And fundamentally, it is catching up. It is doing very well. Its products are very well diversified. So it trades around 2.2 times price to embedded value FY27. So we think there's further scope for this to come closer to HDFC Life for multiple. And that's our main argument of being a good, attractive opportunity to invest in.
Understood. Samarth, the fundamentals in India's insurance market, the prospects are looking very strong. Swiss Re, I saw a statistic here, says that in the coming 5 years, total insurance premiums will grow by 7.1% in real terms. That's well above the global averages. Does that sound right to you? And how much scope for growth is there exactly? And that's always a reflection of just how underpenetrated or underinsured or even uninsured households are in India.
Yeah, you put the right point. The underinsurance is a criteria that is playing out. But the numbers which Sri put out around 8%, 7 to 8%, life insurance slightly lower and general insurance slightly higher, that looks sensible to me because given the underpenetration in the general insurance sector, it is only 1% compared to 1.9% of average emerging market average. So I see the further scope for increasing it. Also, in terms of, I already alluded the point that commercial lines have a very good, strong growth scope opportunity. Whether it be liability lines, that is, we have only scratched the surface as yet. So fire, liability lines, marine lines, these are the lines which will see strong and healthy growth. Motor still sees strong competition. Motor sales as such have sort of slowed down, but I still see the premiumization trend to SUV that is playing out. So we expect 7 to 8% growth in motor insurance premiums. Health remains a very strong growth area driven by the medical inflation and people
Yes.
awareness of having the cover. So that is growing on very well. There is some impact from the accounting changes that had impacted the optically. So, I mean, I won't go into much detail, but optically, the health insurance premium looked slightly lower. But if you compare like for like, the health insurance premiums are very strong, and we expect it to remain strong for the foreseeable future. So these
Understood.
are the primary drivers, which will drive the general insurance sector growth.
Samant, how significant, though, are the challenges holding back that growth from a customer point of view? And I want to bring in how insurance is taxed. I want to bring in what appears to be quite a cumbersome claims process and the overall complexity and perhaps confusion in the customer experience, and what role perhaps insurtech and digital integration can play in simplifying the process.
Yeah, so GST changes that were long awaited in terms of, if you see the health insurance premium all taxed at GST rate of 18%. So this is a long debate that government should pull it down to 5%. There had been certain GST council meetings as well, but that decision has not been yet taken. We are awaiting some of that. So in terms of both health insurance and the term insurance, there should be a reduction of GST premiums because GST rates, because as such, the health insurance companies keep on revising rates upwards. That makes it difficult for policyholders to continue the policies for longer. In terms of the longer term objective of government to make insurance for all by 2047, we need to see constant innovation, product simplification. So those sort of things which will make products much more appealing to customers or policyholders. You rightly alluded that the insurtech can play a very good role in there in terms of more modular sort of projects, products, as well as sort of making it the whole buying process simpler.
Yes.
So those things are required to sort of propel the growth.
Samant, can I bring in the role that the banks play, which is a critical one, isn't it, in terms of the distribution channel for the insurance market? The banking network in India brings in over 50% of premiums for the insurance sector. Top-down policy objective, and you alluded to this, is insurance for all by the year 2047. How then does bank assurance help reach that objective from a distribution channel point of view?
So if you see the life insurance sector, the background, all big private sector companies, whether it be HDFC Life, ICICI Prudential, or Axis Max Life, SBI Life, these are all bank-supported companies, and almost 60 to 70% of distribution through APE comes from the banking channel in terms of the APE. So that remains a very key primary sort of distribution channel for all these bank-sponsored insurance company. So we see that there was some rumor of mis-selling in terms of banker channel, but we don't think there will be any sort of outright cap on the banker insurance channel per se, because that is very critical for the growth, overall growth of the insurance sector. And any outright cap will be in contradiction to the government objective of insurance for all for 2047. So an outright cap won't be there, in most probability. Also, the government sort of tries to reduce the mis-selling. So in terms of the video recording of selling of a sales process, those are the things which are being pushed for. But the banks are complying with that. So we don't think so. There's an outright cap that is sort of anything that is we will see.
So is everyone a winner here, Samant? And is there sector-wide momentum that extends to names like, they're on the screen right now, HDFC Life and SBI Life?
Yeah, so these are very good companies in terms of, if you see the primary metrics we judge the fundamentals of the companies, of life insurance companies, is the growth of embedded value. So in the last 5 to 6 years, the embedded value has grown very healthy pace, around 19 to 20%. Return on embedded value also stayed around that range, only except iPru, which has seen much more volatility. So these are the good companies for long-term investment. And as I alluded earlier, there was de-rating that actually was a disconnect between their operating performance that they had been showing, and the performance has been quite resilient as such. And they are also showing some adjustment to the new sort of demand scenario, whether the unit demand slows down and the traditional product mix demand picks up. The companies are launching new products. So we see that the slower growth in the transitory period, and then the growth will pick up. And these companies remain a very good sort of long-term investment opportunity.
Great conversation, Samant. Thank you very much indeed for your insights on India's insurance sector. Thank you. Samant Singh there from Fiddle Capital, India. Right, let's take a look at shares of Reliance. The Indian conglomerate reports earnings tomorrow, but its Russian oil purchases are already in focus. The Mukesh Ambani-led company boosted its Russian oil imports by 37% last month compared to May. New Delhi's overall crude imports from Moscow are also making the headlines as President Trump threatens 100% sanctions on buyers of Russian oil. CNBC's Dan Murphy spoke with former US National Security Advisor John Bolton and asked him how this warning could impact countries like India and China.
There's no sign from either those countries and some other smaller purchasers of Russian oil and gas that their behavior would change. This has been a fundamental problem from the start of all the sanctions imposed on Russia, including Europe. They've been imposed in a scattershot fashion. Example, Europe is now considering its 18th sanctions package. Well, if the first 17 were good ideas, why weren't they applied in February of 2022 when the invasion started instead of stretched out? And the way the oil sanctions were approached, with trying to allow some oil but with a price cap because they wanted to keep the domestic price at the pump of gasoline down, really was a huge loophole that Russia drove right through. And I'm sure that even if they were faced with these punitive sanctions Trump has threatened, they try and find ways through that too. If we don't enforce the sanctions, then they're not going to work, and we've not been good at enforcement either.
Back at home in Singapore, City-State seems to be diversifying its exports away from oil. JP Ong joins us with the details, and you're breaking out the NODOX, the export numbers, and the pharmaceutical sector was one interesting aspect.
Actually, you're right there, Sri, and we'll get to the pharmaceutical numbers in a bit, but the headline number seems rather encouraging, especially since we did come off that surprise contraction in May. Well, it did come back with a vengeance this time around. Exports, non-oil domestic ones from Singapore actually in the month of June, growing by about 13% year on year. That's more than double the growth rate that economists surveyed by Reuters were actually expecting. And they also saw electronics exports grow by about 8% for this time. We talked about the diversifying away from oil, but because Singapore is also a huge petrochemical refiner, actually, this will be something that's key actually for them, because they do export a lot of petrochemicals to Southeast Asia. But because a lot of these countries in Southeast Asia are starting to buy more oil and gas from the U.S. to try and achieve better trade terms and trade deals with the world's largest economy, that could have a negative impact actually on Singapore. Now, I want to talk about pharmaceuticals again, Sri, because this is one of these sectors that's seen as the next frontier, actually, for Singaporean manufacturing, and also becoming a growing, or was at one time one of the faster-growing export commodities from Singapore. Take a look at how pharmaceutical exports in the last 12 months have actually started to fall from its peak of about $3 billion just in March of 2023. You'll notice it's actually fallen below $1 billion, actually, 1 billion Singapore dollars in the month of June to about 870 million during that time. Now, it's important to note this also, Sri, because as we know, one of the sectors that Donald Trump, or the Trump administration, has actually said they want to target is to put a 200% tariff on pharmaceutical exports. So this is something that's going to be an issue for Singapore. We remember that Singapore itself, while they're trying to negotiate better tariff terms with the U.S., one of the key focuses for Singapore is a targeted approach, which means that Gan Kim Yong, the Deputy Prime Minister, has actually said that what they want is to actually achieve better terms for the pharmaceutical industry in Singapore to make sure that they are not tariffed at that high rate going to the United States, and thus also highlighting why this is an important sector for Singapore. I bring this up also because who else has a huge and burgeoning important pharmaceutical sector? That happens to be India as well, which is a leader in producing vaccines to generic pharmaceuticals and drugs also. And this is something that India will probably have to also reconsider, because while India is trying to work out that mini deal with the U.S., this very important sector of India actually might be something they'll have to focus on and pay attention to, because it's something Singapore is taking seriously, and perhaps the subcontinent should as well.
Still a lot of risk, you're quite right, associated with sectoral tariffs, even though headline seems to be a little bit more manageable. Thank you very much indeed for that, JP. Right, Indian markets are up and running. We'll bring you the opening trades and some stocks in focus. We're back in 2 minutes. Welcome back. Let's bring you up to speed with the market action for the benchmark Nifty 50, which is about more than 15 minutes into the opening trades, and holding a line at 25,213. Earnings are going to be the big factor that are going to be colouring the market sentiment and confidence levels today. Let's give you the exchange rate while we're at it. Dollar rupee at 85.85. Let's take a look at some specifics and shares of Tech Mahindra, India's fifth largest IT services company, posting slightly lower than expected revenue for the first quarter. Sales rising 2.7% to just over $1.5 billion, just below estimates. The Americas which makes up half of Tech Mahindra's revenue, saw sales fall nearly 6%. That's the biggest drop in almost 5 years. IT firm flagging weakness in auto and manufacturing as markets continue to remain volatile. Despite this, new deals hit $809 million, showing clients are still spending, but cautiously amid tariff uncertainty in the United States. Tech Mahindra down by 1.3%. Tech Mahindra's peer, LTI Mindtree, also reporting earnings today. Let's take a look at the stock, down by 0.6%. Turning to hospitality, ITC Hotels reported a 54% surge in Q1 profit, driven by strong room sales, which jumped 16% year-on-year. India's hospitality sector saw robust growth in 2024, fueled by rising domestic travel and increasing demand for wellness-focused stays. Country's travel retail market is projected to more than double by the year 2030. The stock down, however, by 1%. State Bank of India has kicked off its $2.9 billion share sale to institutional investors. This marks the biggest equity capital raising by an Indian entity and the first such move by a public sector bank in 8 years. The offer price is set at around 811 rupees a share, slightly below Wednesday's closing price of 831 rupees. The stock currently trading at 831 rupees 90. That's all the time that we have today on Inside India. Do keep watching CNBC. Access Middle East with Dan Murphy is coming up next.